Greetings, everyone. There are times when proactive market communication is warranted, and I believe that this is one of those times. So if after listening to this video, you still have any questions or concerns, I would invite you to proactively reach out to us because it's always better to over communicate than to not communicate at all. That being said, I think you would agree that I have had major concerns with the valuation in the U.S. stock market for quite a long time. This concern has been mostly concentrated in the U.S. large growth area and specifically in the Magnificent Seven stocks. These valuations have never been as high as they are since the dot-com craze in the late 90s when I started my career as a financial advisor. These valuations, in fact, were so high that even Warren Buffett had moved a record number of his investments into cash. So the last 15 years, diversification has not worked. The S&P 500 index has trounced all the other categories of the stock market. And so hopefully now with what's occurring, that diversification now is coming back in vogue. So as it relates to the performance, you see the chart on the screen. It's the U.S. Stock market. So we categorize any publicly traded company in terms of their sizes. Are they a small, mid, or large size public company? And then are they value or growth? You can see the 10-year number shows that the growth area has trounced the value side of the markets, doubled up on them. Well, here we sit year to date, and you can see that now growth is down much more than value. And so hopefully this, what we're trying to do is not hit home runs with your money. We're trying to protect your downside as well. And so you see up top, the S&P 500 index as the close of business on Friday was down 13.4%. Our clients' portfolios, as it relates to their equity portion, is down 8%. So it's a nice difference. Diversification works, but most importantly, what you want to do is, if you down 13.4, you need a 15% upside to get back to break even, whereas you only need a 9% recovery to get back to break even there. So that's why we always try to protect on the downside rather than try to get you home runs on the upside. Now, that being said, this is my favorite slide that I've probably shown all of you. It's the S&P 500 index by year. It's 2025 is on the far right, and it goes back 45 years to 1980. And I love using this slide because it shows you what the calendar year performance was for the S&P 500 index, but it also shows the red dots. The red dots are the inter-calendar year volatility. And what it shows you is it's like with every given calendar year, what was the peak to trough drop within there from the S&P 500 index? And you'll see that it's fairly common to have a 10% drop in any given year, but yet many times the markets still return positively for the calendar year. So at the close of business on Wednesday of last week, we were at a 10% peak to trough. Right now, as we currently are sitting here at the end of Friday, we're at a 17%. So once it hits 20%, you're going to see all kinds of news articles that talk about when you hit a 20% peak to trough, we're in a bear market, right? And I can honestly say that even in these years where it did hit kind of a 20% downturn, you still many times ended up positive for that calendar year. So all of the economists out there, back in November and December, were predicting a pretty darn good year in the economy and the markets for 2025. Now you fast forward to what we're dealing with here with the tariffs, and now they've all changed their tunes saying that we may go into a recession. What I would say to that is that they discount the strength of the U.S. consumer. The U.S. consumer loves to spend. We're addicted to spending. We got shut down for COVID, and somehow or another we continued to spend money. It wasn't on travel and maybe not restaurants as much, but we still spent. Certainly there's a high probability that cars and all those other types of things are going to be higher priced, and it's going to be harder for us to afford those things. But trust me, these dealerships, they're going to figure out a way to keep selling cars, and the U.S. consumer is going to keep figuring out ways to spend money. So I'm not 100% convinced that we're headed for a recession. What I would look to monitor is the unemployment rate, because if we're at full employment, people still have their jobs. They're going to be still spending money. And also one of the major things is looking at their mortgage payment defaults, because people will not pay their car loans or their credit cards. But when they stop making their home mortgage payments on time, that means there's something going on with the economy. So hopefully this helped you kind of look at where we're at currently and the history of the markets over any given year. Now, what should we be doing? What are we trying to do? So the two things Jacob and I are doing is, one, we're monitoring all of our clients' accounts for rebalancing. And then the second thing is, if it's a taxable account, we're monitoring it for tax loss selling, tax loss harvesting, it's called. We still have your portfolios tilted towards the value. So we're confident that if these markets continue a downward trend, that you're not going to go down near as much. And then from your standpoint, we have two types of clients. We have those that are not retired, and we call them the accumulators. You're in the accumulation stage of your lives. And then we have retirees, people who are in the spend down phase of their lives. For the accumulation people, again, I would encourage you to pull out those couch cushions and gather up whatever extra dollars you have, because this may end up being a very good buying opportunity, like it was in the early 2000s when the dot-com craze burst, right? I was 30 some years old there, and these were the best buying days of my whole career. So definitely think about if you have any excess dollars to invest. For the retiree clients that we have, certainly a much bigger concern for all of you. But if you recall, we basically coach you to have excess cash reserves on hand to buy you time when things like this happen. And we also encourage you to have a home equity line of credit just sitting out there in case, again, that we might want to dip into that on a temporary basis just to buy us time. So hopefully this has been helpful to you. Definitely reach out with any questions. I'm going to leave you with this quote. So Benjamin Graham was the value investor. That's who Warren Buffett idolized. And the quote that he had in one of his books was, "Markets can be fickle. They can be susceptible to extremes of overexcitement," which has been overexciting the last few years, and extremes of pessimism, which it appears that we're entering into right now. He goes on to say, intelligent investors know this and take advantage of the stock market rather than allowing the stock market to take advantage of them. So keep a level head, reach out with questions and concerns, and just know that we are monitoring your portfolios on actually a daily basis now. And let me know if you have any questions. Thanks.